All these are more signs. By definition, the stock market entered bear territory in July and has only gone further south ever since. A market is considered bear when stocks lose approximately 20% of their value. As of the end of October, stocks are off more than 40% from their high in October 2007. That is a much faster decline than occurred even during the Great Depression. Even then, it took 2 years for markets to lose as much as the 2008 bear market has already cost investors. That tells us something right there. These times are not normal times. The Depression-era bear market ended in June 1932 after stocks declined approximately 80% from the August 1929 peak. So then, bears expect further declines. The evidence, they say, is now everywhere. Just look around. Investing is always a balancing act between risk and reward. The bears see lots of risk. They don't see anyone reaping much reward at all, and they can't find much evidence the risks are going away, or that investors are prepared to take the risk necessary to reap rewards. So until something changes, the bears say the stock market will probably keep heading downward, a downward spiral. And again, these are not normal times. Consumer confidence tells the tale. The Conference Board's Consumer Confidence Index hit a record low in October. About 2/3 of the American economy depends on consumer spending. When consumers are worried, they just don't spend. And without spending, there are no corporate earnings. And without earnings, stock prices slide even further down. We're looking at a very sharp pullback in consumer spending. The economy is already showing the stress. Whirlpool Corporation announced it will cut 5,000 jobs. American Express plans to cut another 7,000 jobs. Consumer spending has declined in the third quarter of this year for the first time in 17 years. And gross domestic product shrank or contracted 0.3% in the period. History indicates the bear market has much further to go. According to Financial Times columnist Tony Jackson, he said that even though the price-earnings ratio shows stock markets are probably fairly valued at the current level of 16, the 6 bear markets the United States has endured since 1920 didn't hit the bottom until they were approximately 50% below fair value. So given the risk, stocks are simply too expensive according to newsletters published by Euro Pacific Capital. Fueling the risk are the by now familiar villains: way too much debt, subprime mortgages, loan defaults, declining housing prices. Greed, pure greed. People and financial institutions can't pay their bills. Even though the Federal Reserve System and the Treasury Department are lubricating every possible gear in the financial system, the debt is still out there, increasing. And housing prices are still declining. Credit card bills are becoming massive, and consumers are losing their jobs. TCW Group, a Los Angeles mutual fund company, says housing prices will decline for at least several more years, and default rates among prime borrowers, business borrowers with excellent credit, could rise from 2% today to as much as 10% or more before the down cycle is over. They don't really know. ETFguide.com, a website that tracks exchange-traded funds, says that in panic times like these, gold prices should be soaring, but they're not. They've been declining since March, and that makes no sense whatsoever. But once again I'll say, these are not normal times at all. There's never been a time like this before, and there'll never be a time like this again. A collapse in oil prices has done nothing to stimulate economic growth. Therefore, ETFguide.com said the country may be facing not just a recession, but a deflationary depression. Yes, a depression that was last experienced in the 1930s. On that order, the world faces a severe financial crisis. Damage in the real economy is only just starting to show up. That suggests there is much, much more damage still to come. And the bears expect declines to be severe. Stock markets are in a free fall. TCW Group predicts the Standard & Poor's index of 500 stocks will decline at least another 30% before the bottom is reached, even though it's all just a guess. James W. Paulson of Wales Capital Management, a bull, says there is plenty of cash sitting on the sidelines ready to fuel another run-up in stocks. But the bears observe that the cash is, as Paulson says, sitting on the sidelines, being hoarded, kept back, which is helping push stocks down even further. So until something brings order to the markets, however possible, if possible, but nonetheless, like I say, these are not normal times. So, until something brings order to the markets, or not, something that will give cash-rich investors the courage to move, the cash will remain sidelined and stock prices will remain low. And then there's something called the burrs. And somewhere between the optimism of the bulls and the gloom of the bears is a place of caution and confusion. The land of the burrs. A lot of investors are there because no one has seen times like these ever before. So no one really knows how things will play out. Every day these days is on-the-job training. So how could the average citizen or consumer ever understand the complexities of overnight repos or reverses, the selling or buying of protection on corporations via credit default swaps, or the reasons why some investment banks are saved while others are allowed to fail? It's just too hard for the average person to understand. The markets have become too complex. The economy has become too complex. All systems are becoming broken. All systems must change. Hugh Johnson of Johnson Ellington Advisors says, the stock markets are being driven by problems which we've never confronted, at least in our lifetime, or than anybody can even remember. As the market hit bottom, after reaching extremely pessimistic levels, some technical and sentiment indicators appear to argue for at least perhaps a short-term bottom in the equity markets. But the ongoing economic slowdown puts earnings growth at risk. Another columnist wrote recently that there is no one right answer, no matter how much investors want it. This is the time to get small, play it conservative, let the storm blow over, supposedly, and make as much money as you safely can while you wait for the trouble to pass. But once again, I say, there is no economist or anybody that can really understand what's going on, because, once again, these are not normal times. One person says, one economist says, they haven't read any first-rate theories. I haven't even read any second-rate theories. But all the options are pretty bad now. Selling stocks at today's lower prices stops bleeding now, preserves capital for future investment, and helps investors sleep better. But returns earned out of the stock market won't keep up with inflation. No, all these are definitely more signs of the end times, transition days. And there are many, many signs. Once again, just look around.